Here's a fact that sounds like it can't possibly be true. For most of American history, you could not get a 30-year mortgage. It did not exist. Not as an option, not as a rare product for the wealthy, not in any form. For the first 150-some years of this country, if a bank agreed to lend you money to buy a home, you typically had somewhere between 5 and 10 years to pay the whole thing back. No 30-year term, no small down payment, no steady monthly bill, slowly chipping away at what you owed until one day it just hit zero. If you wanted a mortgage before the 1930s, you needed to hand over something close to half the value of the home in cash up front, and then pay mostly interest for years, with the entire remaining balance due in one enormous lump sum the moment your loan matured. And yet somehow, millions of Americans still found a way to own homes under that system, scraping together savings, leaning on family, joining tiny community lending clubs, and hoping their banker would agree to renew the loan when the bill came due. It worked, in the sense that a system can work for a while, right up until the moment it doesn't. That moment arrived in the early 1930s, when the worst economic collapse in American history slammed into a mortgage system that had never been built to survive one. If you have a mortgage right now, or you're saving for one, every single month you are living inside a financial invention that is barely 90 years old. The predictable fixed 30-year payment you budget your life around is not some timeless feature of capitalism. It is the direct, deliberate result of a crisis that nearly destroyed American homeownership altogether. So what actually changed in 1934 that rewired how every single American buys a home for generations, right up to the mortgage sitting in your inbox today? The people who built the mortgage industry we know now didn't stumble into it by accident. They built the system before it first, watched it collapse under almost half the country at once, and then built something else entirely in its place, something that would quietly decide who got to become a homeowner in this country and who didn't for decades afterward. Let me take you back to the beginning. Picture America in, say, 1910 or 1925, before any of this existed. If you wanted to buy a house and you weren't wealthy enough to pay cash outright, your options were genuinely limited. You could go to a commercial bank, though many banks in this era considered home lending a fairly minor, almost reluctant sideline compared to business and agricultural loans. Or you could go to what was called a building and loan association, a smaller community-based lending club. Either way, the mortgage you got looked nothing like the one you'd recognize today. Lenders typically demanded a down payment of 40 to 50% of the home's value. Think about that for a second. Not 5%, not even 20, half. And even after you scrape that together, the loan itself usually ran just 5 or 6 years, sometimes stretching to 10 if you were fortunate. Most of these mortgages weren't even designed to pay themselves off. You made interest-only payments for the life of the loan, and then at the end of that 5 or 6 years, the entire original loan amount, the full principal, came due all at once. That's called a balloon payment, and it is exactly as unforgiving as it sounds. Picture an ordinary family trying to do this the honest way in, say, 1922. A factory worker and his wife, saving for years just to reach that 50% threshold, finally buy a modest home for $2,000, a fairly typical price for a small home at the time. That means a down payment of roughly $1,000 in cash, an enormous sum for a working family to accumulate at all, often built up penny by penny over the better part of a decade. Then, for the next 5 years, they pay interest every month, and interest only, watching the loan balance barely move. Then the letter arrives. The note is due in full this year. If the bank says yes to renewing it, life goes on exactly as before. If the bank says no, for any reason, a bad year at the mill, a change in local lending policy, a banker who's grown nervous about the economy, that family loses the home, the down payment, and years of payments all at once through no fault of their own. But here's the critical detail most people overlook. You couldn't just walk away and forget about that looming balloon payment, because almost nobody had the cash sitting around to pay off an entire home loan in one lump sum. So what actually happened, in practice, was that borrowers depended on their bank agreeing, informally and with no real guarantee, to renew or refinance the loan when it matured. It usually worked out. Your local banker knew you, knew your income, knew your neighborhood, and quietly rolled the loan forward again and again. This whole informal system rested on one fragile assumption: that credit would always be available when you needed it. And that assumption held up fine, right up until the moment credit disappeared, everywhere, all at once, for everyone. There was also a quieter workaround many families relied on: the second mortgage. If you couldn't scrape together the full 40 or 50% down payment a first mortgage demanded, you could sometimes layer a second, smaller loan on top of it, often from a different lender entirely, at a steeper interest rate. It let a few more families squeeze into home ownership. It also meant that a single missed payment on one loan could trigger a cascade across both, since the two lenders rarely coordinated with each other at all. Two separate lenders, two separate renewal dates, two separate chances for the whole arrangement to collapse. Most people budgeting for a home today never have to think about anything like it. Now, it would be unfair to pretend this early system was pure catastrophe waiting to happen. In 1831, a small group of workers in Frankfort, Pennsylvania, outside Philadelphia, founded something called the Oxford Provident Building Association, widely credited as the first building and loan association in the United States. The idea was genuinely elegant. A group of neighbors would pool their savings into a shared fund every month, and members would take turns borrowing from that pool to buy or build homes, paying the group back over time with interest that stayed inside the community instead of flowing off to some distant bank. The order in which members actually got to borrow was often decided by auction right there in the meeting room, with members bidding a premium for the right to go first, a system that turned the whole enterprise into something closer to a cooperative than a bank in any modern sense. These associations weren't chartered by Washington, weren't insured by any federal agency, and answered to nobody but their own members. That decentralized, small-scale structure is exactly what made the model spread so quickly, and, decades later, exactly what would evolve into the savings and loan industry that dominated American home lending through much of the 20th century, an industry with its own dramatic collapse still waiting decades down the road. But that's a story for another video. It let working-class families who commercial banks often ignored entirely find a real, structured path toward owning a home decades before the federal government ever got involved in housing at all. The model spread slowly at first, then exploded. By 1920, roughly 5 million Americans belonged to a building and loan association, holding a combined $2.5 billion in assets. By 1930, membership had swelled to over 12 million people, with total assets north of $8.8 billion, spread across more than 12,000 separate associations nationwide. For an enormous slice of working America, these small, member-run institutions weren't a backup option. They were the only realistic door into homeownership that existed at all. Sound familiar? It's the same basic instinct behind every credit union and community bank that still exists today. People trusting people they actually know, instead of an anonymous algorithm somewhere. Compare that for a second to how you'd apply for a mortgage today. You fill out a form online. An automated system pulls your credit score, your income history, your debt ratios, and spits back a preliminary answer, often within minutes, from an institution that has never met you and never will. There's real convenience in that. There's also nothing resembling the personal, face-to-face relationship a 1920s building and loan member had with the small group of neighbors deciding whether to lend him their pooled savings. We traded intimacy for scale and speed for standardization, and mostly, we don't even notice the trade anymore. But the building and loan model had a structural ceiling it could never fully escape. Even the friendliest, most community-minded association was still, underneath it all, running on the same short-term balloon payment logic as everyone else. It softened the edges of a broken system. It didn't replace the system. And that's where the trouble began, because the entire structure, banks and building and loans alike, was one bad decade away from disaster. That decade arrived in October of 1929, and it kept arriving for years afterward. By the early 1930s, the housing market that had once seemed sturdy was in a genuine death spiral. Home values were collapsing across the country. Unemployment was climbing past 20% nationally. And every single one of those short-term mortgages, the ones built on the assumption that a bank would always be willing to renew, suddenly hit a wall because the banks themselves were failing by the thousands, and the ones still standing had absolutely no interest in extending new credit to anyone. By 1933, historians estimate that somewhere between 40 and 50% of all home mortgages in the United States were in default, not late, in default. Nearly half the country's homeowners. The building and loan associations that had looked so sturdy just a few years earlier were caught in exactly the same trap. Their number fell from just over 12,000 associations in 1929 to roughly 8,000 by the end of the decade. Not because panicked members were storming the doors demanding their money back, but because the bank failures and collapsing property values around them made it nearly impossible to keep collecting on the loans they'd already made. A system built entirely on steady, predictable neighbors making steady, predictable payments had no answer for a country where almost nobody's income was steady or predictable anymore. Here's the part everyone forgets. This wasn't just a story about numbers on a bank's ledger. It was a story about armed standoffs on courthouse steps. In the Farm Belt especially, where land itself was often the only collateral a family had, foreclosure auctions turned into open confrontations between neighbors and the law. Farmers organized what came to be called penny auctions. When a foreclosed farm went up for public sale, dozens or even hundreds of neighbors would show up, intimidate away any outside bidder who dared raise a hand, buy the entire farm back for a few cents on the dollar, and hand the deed straight back to the family who'd just lost it. It was resistance dressed up as an ordinary legal auction. Foreclosure rates had been climbing for years before the crisis fully peaked. And by 1933, at the worst of it, historians commonly cite foreclosures running at somewhere around 1,000 homes a day nationwide. 1,000 families or more on an ordinary day, losing the roof over their heads month after month after month. Farmers, whose entire net worth was usually tied up in land and equipment rather than savings, were hit even harder, and their anger increasingly boiled over into direct public confrontation. On the 27th of April, 1933, that resistance turned violent in Lamar's, Iowa. A crowd of somewhere between 150 and 250 farmers, many of them furious over a wave of foreclosure judgments, stormed the Plymouth County Courthouse. Led by a man named Morris Cope, who reportedly showed up with a bloodied bandage from an earlier scuffle that same day, the mob pushed into the third-floor courtroom of Judge Charles Bradley as he was finishing up for the evening. Read that again. An American judge dragged from his own courtroom in his own county by a crowd of his own neighbors. One witness account of the mob's mood put it bluntly, "Let's go up and throw the fear of God into Bradley." Bradley refused to promise he'd stop signing foreclosure orders even as the mob roughed him up and hauled him out of town. Iowa's governor, Clyde Herring, declared martial law in Lamar's in the incident's aftermath, sending in troops to restore order in a county courthouse that had, just days earlier, been the site of an American judge nearly lynched by his own neighbors. It made national news, and it was far from the only courthouse confrontation of its kind that year, as similar standoffs and penny auctions spread across Iowa, Nebraska, and Minnesota throughout the farmers' holiday movement's most intense months. This was not some distant abstraction of a financial crisis. It was neighbors turning on judges, and judges turning on neighbors, because a mortgage system built for stable times had absolutely no answer for instability. There was another piece of the 1920s mortgage world that made the collapse even worse, and it's a piece with an uncomfortable echo you'll probably recognize. Alongside traditional banks and building and loans, a wave of real estate bond companies had sprung up during the decade's housing boom, bundling individual mortgages into bonds and selling them off to investors who never met a single homeowner whose loan they now partly own. It let more money flow into real estate lending than the old relationship banking model ever could on its own. It also meant that when property values started falling, the losses spread instantly to investors scattered across the entire country, with nobody local left who actually knew the borrower or the neighborhood well enough to work out a reasonable fix. Sound familiar? It's the same basic vulnerability, mortgages bundled up and sold off to strangers, that would resurface on a far larger, far more technologically sophisticated scale more than 70 years later. If you had lived through that world, the fear wouldn't have been abstract at all. It would have been the specific dread of watching your loan's maturity date creep closer on the calendar, knowing the bank that used to renew your note without a second thought might not exist anymore by the time it came due. It would have meant walking past boarded-up windows on streets that had been thriving 5 years earlier and wondering whether your own name was next on a foreclosure notice pinned to a courthouse bulletin board. But here's the fair part of this story, the part that's easy to skip past in a narrative about villains and victims. The bankers and building and loan officers of that era mostly weren't cartoonishly greedy men twirling their mustaches. Most of them were operating inside a system that had simply never been designed to absorb a shock of this size. A system built for small-town relationships and gradual growth, not for 20% unemployment and a collapsing currency of trust. The system's failure was structural, not purely personal. That distinction mattered enormously for what Washington decided to build next. And that's where the trouble reached Washington directly. Because by 1933, the scale of the crisis had grown far too large for individual banks, individual building and loans, or individual state governments to fix on their own. On the 13th of June 1933, President Franklin Roosevelt signed the Homeowners Loan Act, creating the Homeowners Loan Corporation, known as the HOLC. Its mission was stated plainly, and it was stated as an emergency measure. Stop the bleeding of foreclosures by refinancing distressed mortgages into something borrowers could actually survive. Overseeing the broader federal home loan apparatus that housed the HOLC was John Fahey, a Massachusetts publisher turned public servant who chaired the Federal Home Loan Bank Board through the mid-1930s and became one of the most powerful, unelected officials shaping American housing policy at the exact moment that policy was being invented from scratch. The HOLC was capitalized with $200 million and authorized to issue up to $4.75 billion in government-backed bonds, an almost unimaginable sum for the era. At its operational peak in the spring of 1934, the agency was processing more than 35,000 loan applications a week out of 458 offices scattered across the country. By the time it stopped issuing new loans in 1936, the HOLC had made just over 1 million loans, refinancing roughly 1 out of every 6 mortgages in urban America into something radically different, a self-amortizing loan, one where a fixed monthly payment steadily reduced both principal and interest over an extended term, with no terrifying balloon payment waiting at the end. Borrowers paid around 5% interest on terms that stretched out well past the old 5 or 6 year standard. The HOLC's own paperwork described it explicitly and repeatedly as a temporary agency, a one-time emergency fix for a one-time emergency crisis. Keep that word in your head, temporary. You are going to hear it again. Because here's the part that rarely makes it into the textbook version of this story. To figure out which loans were safe enough to refinance, the HOLC didn't just look at individual borrowers. It sent an army of field appraisers out on foot and by car, block by block, street by street, through more than 200 American cities, physically walking neighborhoods, interviewing local bankers and real estate agents, and filling out standardized survey forms on everything from building age and construction quality to who, specifically, lived there. All of that fieldwork got distilled down into a single color on a single map for every neighborhood in the country. Each neighborhood got a letter grade and a color on a map. Grade A, colored green, meant best. Grade B, colored blue, meant still desirable. Grade C, colored yellow, meant definitely declining. And grade D, colored red, meant hazardous. Those maps are exactly where the term redlining comes from. Here's the critical detail most people overlook about those maps. The grading wasn't based purely on income or home condition or even default risk in any narrow financial sense. Pulse appraisers routinely mark neighborhoods down specifically for the presence of black residents, immigrant communities, or any population the appraisal manuals described using language about racial or ethnic homogeneity. A stable, well-maintained neighborhood could still get graded down to a D purely because of who lived there. Historians Liddell Windling and Todd Mitchney, who have traced the roots of this practice back through New Deal-era lending records in detail, describe the Holk surveys as the moment federal money and local prejudice became permanently administratively fused, block by block, in city after city across the country. This wasn't one rogue office acting on its own. Appraisers ultimately mapped more than 200 American cities using the exact same 4-color scale. The Holk itself was wound down and formally dissolved by 1951, its mission complete, its charter closed, every bit as temporary as its founding documents had promised. But the maps it drew, and the underwriting logic behind them, did not retire along with it. That logic was about to become federal policy for the next 3.5 decades. So, let's finally answer the question this whole video opened with: what actually changed in 1934? On June 27th of that year, President Roosevelt signed the National Housing Act, creating the Federal Housing Administration, the FHA, and installed an oil industry executive named James Moffett as its first administrator. And this is the single piece of legislation that quietly built the mortgage you'd recognize today. Instead of the government lending money directly, the way the HOLC largely had, the FHA insured mortgages issued by private banks. If a borrower defaulted, the government, not the bank, absorbed the loss. That single guarantee changed everything about what a private lender was willing to offer, because it removed almost all of the long-term risk that had made banks so reluctant to lend for decades in the first place. Suddenly, banks could safely extend loans with down payments as low as 10%, amortized in full over 20 and eventually 30 years. No balloon payment, no 5-year renewal gamble, just one predictable number, the same every month for 3 decades. Private lenders, watching this new FHA-insured product succeed, began adopting the same long-term, fully amortizing structure on their own conventional loans too, just to stay competitive. Within a few short years, the balloon note mortgage that had defined American home lending for over a century was functionally extinct. The 30-year mortgage had arrived, and arrived to stay. The scale of the shift shows up plainly in the homeownership numbers themselves. After bottoming out around 43.5% in 1940, in the immediate wake of the Depression, the national homeownership rate climbed to roughly 62% by 1960 and kept climbing from there, decade after decade, on the back of a mortgage product that simply had not existed for the vast majority of American history before it. The machine got another massive push barely a decade after the FHA was created. When millions of soldiers came home from the Second World War, the Servicemen's Readjustment Act of 1944, better known as the GI Bill, extended a version of that same government-backed 30-year low-down payment mortgage, specifically to veterans, this time through the Veterans Administration instead of the FHA. Entire new suburbs, built almost overnight on farmland outside cities like Philadelphia and New York, sprang up to absorb the wave of newly eligible buyers. The system built in 1934 to survive one emergency had, within about a decade, become the standard tool for building an entirely new kind of American landscape. Now for the twist most people never hear. When the FHA wrote its own official underwriting manual in 1938 to guide which loans it would insure, it didn't invent a new evaluation system from scratch. It borrowed the Holk's neighborhood grading logic almost wholesale, and then wrote the racial reasoning behind it down in plain, explicit language. The manual warned lenders about what it called the infiltration of inharmonious racial groups, and it went on to actively recommend racially restrictive covenants, legal language in a property deed, literally prohibiting the occupancy of properties except by the race for which they were intended. Read that again? The very same federal agency that made the 30-year mortgage possible for millions of American families also wrote racial exclusion directly into the rulebook that decided who those families would be for more than 3 decades, until the Fair Housing Act of 1968 finally outlawed the practice. It's about power, in the end. Who pays, who benefits, and who decides. And in 1934, the federal government decided both of those questions at exactly the same time in the exact same paragraph of the exact same manual. But that's a story for another video, because the racial legacy of the FHA alone could fill an entire documentary on its own. For now, there's one more piece of machinery that made this whole new system actually stick, and it's a piece almost nobody talks about. In 1938, the government chartered the Federal National Mortgage Association, nicknamed Fannie Mae, to buy up FHA-insured mortgages from the banks that originated them. That single move let banks turn around and lend that same money out again immediately, instead of sitting on a 30-year loan for 30 years. It created a constantly flowing secondary market for mortgages, a piece of financial plumbing so effective that it became essentially invisible. A sister institution, Freddie Mac, joined the same basic job in 1970, giving the system a second competing pipeline for exactly the same purpose. Together, they didn't just move money around. They standardized it, turning millions of individual, locally negotiated home loans into a single, interchangeable national product that Wall Street could package, price, and trade almost like any other security. You don't see Fannie Mae's name on your monthly mortgage statement. You're not supposed to. That invisibility is exactly what made the system durable enough to survive for the better part of a century, largely unchanged, humming along quietly underneath every home closing in America. So what was actually lost when the balloon note relationship banking world of 1920s America gave way to this new federally backed system? In one sense, an enormous amount was gained: predictability, protection against sudden bank failure, and a homeownership rate that climbed steadily for decades after bottoming out around 43.5% in 1940. But something else was lost at the exact same moment, quietly, on paper, in colored ink on a map. The consequences of those Holk and FHA grading maps did not stay confined to the 1930s and 1940s. Research on formerly redline neighborhoods has found that roughly 74% of the areas graded hazardous back then are still low to moderate income neighborhoods today, nearly 80 years later, and close to 64% of those same areas are now majority-minority communities. According to historian Kenneth Jackson of Columbia University, whose research helped establish just how directly federal housing policies shaped the racial geography of American cities, the government essentially became, in his words, a national real estate agent, one that stacked the deck for white suburban buyers for decades. As of 2019, the homeownership rate for white households sat at roughly 73.7%, compared to about 44.6% for black households and 48.1% for Latino households, a gap that traces back, in real and measurable part, to decisions made on grading maps drawn nearly 90 years ago. Think about what that means for two families today, buying homes in neighborhoods just a few miles apart. One of them is very likely sitting inside what used to be a green, A-graded neighborhood on a map drawn in the 1930s. The other is very likely sitting inside what used to be marked red. Neither family chose that map. Neither family was alive when it was drawn. And yet the accumulated difference in home equity between those two neighborhoods, built up slowly across 90 years of appreciation, refinancing, and inheritance, still shapes what each family can afford, borrow against, or pass down to their own kids right now, this year, on the mortgage they're signing today. Let's be fair to the era before all of this too, though, because it's easy to romanticize the old system now that it's gone. The pre-1934 world of relationship banking and building and loan associations wasn't some lost golden age of universal homeownership. It excluded most working Americans just as thoroughly, just through a different mechanism. A 50% down payment locked out nearly as many families as any redlining map ever did, and a family with an unsympathetic banker could lose everything just as fast as a family caught on the wrong side of a color-coded map a decade later. Neither system, the old one or the new one, ever came close to being fair to everyone. They were simply unfair in different directions for different reasons to different people, and each one left its own kind of scar on the neighborhoods it touched. It's also worth saying plainly that the HOLC and the FHA were never staffed by people who thought of themselves as villains. Most of the economists, bankers, and government appraisers who built this system in 1933 and 1934 genuinely believed they were solving a straightforward technical problem. How do you responsibly get money flowing back into a frozen housing market without repeating the collapse that had just happened? Judged purely on those narrow terms, refinancing 1 million distressed mortgages and inventing the fully amortizing 30-year loan, they succeeded spectacularly. It's the quiet decision buried inside that success. The choice to encode racial exclusion directly into the definition of a safe investment that turned a rescue into something with consequences nobody fully reckoned with for another 3.5 decades. And this story is still being written today. According to Greg McBride, chief financial analyst at Bankrate, the 30-year fixed-rate mortgage is, in his words, a uniquely American construct. Almost nowhere else in the world can an ordinary buyer lock in one fixed monthly payment for 30 entire years. In the United Kingdom, most buyers fix their rate for as little as 2 to 5 years before it resets. In Canada, homeowners typically renew their entire mortgage every 5 years, much like an updated version of the old American balloon note, just with far less catastrophic terms attached to it. In most other countries, as economist Enrique Martinez Garcia has explained, that long-term interest rate risk gets passed straight through to the household, to the buyer, instead of being absorbed by institutions built specifically to carry it. The reason America is the exception traces directly back to the machinery this video just walked through. Government insurance removing the risk from private lenders, and a secondary market standing ready to buy the loan the moment it's made. The system born out of the wreckage of 1933 and 1934 is still the exact scaffolding underneath every mortgage closing in America right now. It was there at the very founding of modern American housing policy, and it's here right now, in the fine print of the loan sitting in your own inbox, or your neighbor's, or your kids someday. It's worth being fair about the present day too, because this isn't a story that ends with the system working perfectly forever, either. The same 30-year fixed mortgage that rescued the country from balloon payment chaos in the 1930s now sits on top of home prices that have climbed dramatically faster than wages for years running. In many cities, forcing buyers to stretch that 30-year term to its absolute limit just to make the monthly number work at all. The tool built to make homeownership more predictable didn't make it automatically affordable. Predictability and affordability turned out to be two entirely separate problems, solved, if they're solved at all, in two entirely separate ways. So the next time someone tells you the 30-year mortgage is just how home buying has always worked, as if it were some permanent law of economics handed down from the founding of the country, you'll know that isn't quite true, and you'll know exactly which crisis, which agency, and which decisions actually built it. It is barely 90 years old, built out of bank failures, penny auctions, a judge dragged from his own courtroom, and a government agency that solved one emergency while quietly writing a different kind of exclusion into the rulebook for the next 3 decades. The balloon payment is gone, the predictable monthly number replaced it, but the question underneath both systems never really changed. Who gets to buy in, who gets left out, and who gets to draw the map that decides the difference? If this kind of hidden history is the kind of thing you want more of, the buried decisions behind the money in your own life, subscribe, because there's another video coming soon that you will not want to miss, and it digs into a different piece of the American financial machine that almost nobody questions until they hear exactly how it was built. It's about power. Who pays, who benefits, and who decides? That question never really goes away. It just changes shape, decade after decade, and it's still shaping the paperwork you sign the next time you buy a home.